When life throws you a curveball, how are you going to handle adversity? Welcome to the Fearless Mindset Podcast, where you're about to go on a journey as I interview security, business, and entertainment leaders on what it takes to stay fearless. I'm your host, Mark Ledlow, and enjoy today's episode. Hello, everyone. Welcome back to the Fearless Mindset Podcast. I am your host, Mark Ledlow, and today we have an amazing guest brought to us by a mutual conference we attended at the Whitefish Summit. Thanks to Susan Libby for the introduction. We were both there and had a great time. I want to introduce Kyle Sweet. He's the co-founder, chief strategy officer at Helio Risk. His background is former police officer turned attorney who has built a career at the intersection of law, risk, and firearms community. He is the co-founder and chief strategy officer of Helio Risk, a captive insurance and risk financing firm, founder and general counsel of CCW Safe, founder of Bold Lane Insurance, as well as the firm out of Jacksonville, Florida, which sells legal insurance to companies as an employment benefit. He was also the sponsor of this year's inaugural Whitefish Security Summit. He's here to talk about captive risk. And Kyle, welcome to the Fearless Mindset Podcast. And I just want to read that to the audience so they kind of know your background.
Thank you. Appreciate being here, Mark. Thank you.
Thanks for your time. And I know you're busy. And also, don't want to forget that he actually is an attorney, and he did that. So what made you go through that kind of torture?
Well, I had no desire to ever practice law. But I wanted to go to law school because back in the early 90s, when I was in law enforcement, I was considering going to the federal level. And at that time, they just weren't hiring. I happened to actually be on a drug raid, and we had the FBI, the DEA, ATF, their task force related federal agencies were on, and they always come in town for the drug raids, the fun stuff. And I was talking about my interest in going to federal level, and they said, "Well, do you have your college degree?" And I said, "Yeah," and I've got that and 4 years of law enforcement experience. And they're like, "Well, they're hiring CPAs and lawyers right now. So, your years of experience are great, but you need more investigative experience right now, or you need a law degree or a CPA." And I'm like, "I'm never going to be a CPA." So I considered going to law school, applied, not knowing anything about it, got good enough on the test scores to get in. And so I made the leap and went to the University of Oklahoma College of Law and graduated in 1997 and took a U-turn midway through. I decided I didn't want to be reading reports and prosecuting cases about guys doing cool stuff. I wanted to be, I had that chapter in my life and I wanted to do litigation, just kind of fell in love with health law. And for the next 26 years, I tried cases for large insurance companies and hospital systems all across the United States and catastrophic injury cases. And through that, kind of got more in the weeds on the insurance side of things. And because I'm a firearms guy and my brother was also in law enforcement, we started some businesses together, providing essentially concealed carry legal membership plans, and called CCW Safe. That grew into us needing captive insurance. And since I had which is essentially the funding mechanism for our membership benefits is what we used captive insurance for. And all of my clients in healthcare had their own captives. And so that was the way they financed their risk. So after a number of years of that, I retired and sold my law firm and have devoted myself to starting businesses in the field of insurance, and particularly captive insurance. So that's where Helio Risk came about. Helio is the hub, the Galileo, envisioned, and we call it Helio Risk because Helio is the hub of a business, and business generates things called it generates a commodity that most businesses only exist as an expense. And that's risk. And so what we do with captive insurance, it's been around for a long time. In fact, over 25% of all written premium in the United States as of 2024 was written through captive insurance companies. And it's expected to be 50% in the next 5 years. It's exploded. The industry's exploded. Wow. And I saw a real gap in the type of services that captive managers who build and manage these insurance companies for other businesses. There was no bespoke options. And I'm somebody who I don't like to buy off the rack. I like to get something that's made for me, so it's more comfortable. And so that's what we did. I had the idea of starting our own captive management company that was a bespoke model, and hired away the chief risk officer from Aon, which is a massive insurance conglomerate, and then an international tax CPA expert named Blake Kerr. And so Heather McClure came from Aon, and I'd worked for her as an attorney for when she ran health systems. And she was always the chief risk officer for these organizations. And we formed Helio, and it's been gone gangbusters since then. We do all industry sectors. We do a lot in firearms, national security related, private equity firms that own a lot of companies in the national security and defense sector, and that's been one of our fastest growing sectors. Is we've seen a lot of decentralization and innovation, because these large corporations don't innovate; they buy innovation, and so, but a lot of these small companies that are being approached by the DoD to do interesting, sexy things in the desert in the middle of the night. Find a very difficult time to get insurance for all their related entities under their ecosystem. And so that's one of the things I've enjoyed a lot is, solving these problems of insurance, but doing it in a way that takes risk and turns it into revenue. Cybersecurity, if you're a milk truck delivery company, you create risk every single day. And some of that risk you understand and appreciate, and you give that risk to the commercial market in exchange for a piece of paper that says, if these series of things happen, we may or may not pay you. And that's the
Right.
tradition. That's the traditional loss-based insurance model that came to us from Lloyd's of London many, many hundreds of years ago. Well, there's new frontiers in insurance that I think able to be tackled and to solve the modern business problems in an interconnected world. Let's take, for instance, what recently happened in the Strait of Hormuz. You have a lot of, insurance for the first time ever was talked about on the nightly news as something that was preventing the flow of unintended, third and fourth and fifth order of effects in our consumer-driven economy. And as you can't get helium, you can't get,
Right.
fuels, you can't get, so all these revenues are being placed, food, transport. There's all these things going in and out of that area of the world that we've been impacted with here. Markets, our farmers can't find markets for certain types of their grain products.
Mm-hmm.
Well, traditional insurance won't cover those risks because shipping is designed to create one thing. The loss that triggers the claim is a hull damage. And so
Wow.
if the hull of the ship is not damaged, then there's no insurable claim that can be made. And
Mm.
so what you can do with a captive insurance company that you can't in a commercial market is you can write the policy for yourself. And so captive insurance is it's policies written for the benefit of the owner of the policy, not policies written for the benefit of the owner of the insurance company, the commercial insurance company who wants to find all these ways has a bias for exclusion. And a captive insurance company, because you're insuring your own risk through a company that you own, you have a bias for coverage.
Yeah, I was wondering how the heck are those foreign entities with those boats out there getting coverage for insurance when they got all these drones coming out and missiles coming out and blowing this. I mean, I would think if I own an insurance company, I'm not covering any of those ships at the moment because of the warfare.
Well, and that's one of the things that make and so your mindset is correct. If it's your own risk, and you can do things that are
Mm.
budget neutral, such as I can take my captive funds and I
Yeah.
can provide security for my boats. I can do counter drone production, so I'm not taking that money's not coming off my balance sheet. It's coming out of my captive, where my risk is
Mm.
financed.
Okay.
And what the basic way captive insurance works in a nutshell is we build you an insurance company that is a licensed insurance company domiciled in the location of your choosing. It could be,
Okay.
Guernsey. It could be Bermuda, Grand Cayman. It could be Oklahoma, North Carolina,
Hmm.
Vermont. There's over 30 states. Over 30
Yeah.
states in the United States have onshore
Hmm.
domiciles for captive insurance. And Vermont is historically the gold standard. And Vermont allows a type of insurance called parametric risk, which is something that is the new frontier of insurance. I believe you'll see in
Hmm.
solving problems like what we saw with the Strait, and that is parametric risk is an insurance that is not it's not the trigger of the insurable loss is not damage. It's the event occurring. So, for instance, you could have multi-tiered parametric risk that was triggered where there's no whole injury or whole damage, but it's the fact the existence of that the ships can't traverse the strait that triggers coverage, and so that coverage is defined by the amount of the commercial risk that goes up. Because what you saw there was they went from 0.125% in commercial insurance of the value of the cargo went to 3 to 8% of the value of the cargo as your commercial insurance cost. And so and then they said it's just not insurable. So the commercial market basically said we're not paying for whole damage. And so, but with parametric risk, someone can insure all of all of their operations and it being insured in the second, and third, and fourth order of effects, even though they don't have damage to the ship itself. So it's just you can insure the ship, you can insure the cargo, you can also insure the business interruption that comes from that otherwise is not insurable in the commercial market. Commercial market doesn't cover third party business interruption.
Wow. So that's why the stock market went nuts for a few days.
Yes.
Because they're cashing out, probably selling their positions for raising equity, I'm guessing, with raising cash to cover those potential losses.
Yeah, and there's a lot of this is far above my pay grade, but when you see a run on a market where there's a lot of losses quickly, sometimes people will use that based on the market we've had over the last 2 years. They'll use
Hmm.
that as an opportunity to called tax harvesting.
Sure.
They'll harvest some losses to offset all the substantial gains the market has seen over the last 18 to 24 months. And
Yeah.
so it's hard for lay people like myself when it comes to that draw a lot of conclusions about what the market's doing since it's such an emotionally driven marketplace. But from an
Hmm.
insurance standpoint, there was an absolute critical issue that has arisen, and that is, I think most Fortune 100 companies have captive insurance already. What we're seeing in war risk related
Yeah.
and conflict related insurance is people are recognizing the commercial market is not built to insure those types of risks economically. It's captive
Hmm.
insurance has to be involved at least to take maybe the first dollars of coverage. So with captives, you can still insure by reinsurance or excess coverage or umbrellas in the commercial market. But you think of insurance as a tower, and a
Hmm.
captive can participate anywhere within that tower. So we build the insurance company and we say we're going to take if there's a $20 million shipping war risk, we'll take the first 5 million where all the volatility exists, which makes the insurance you take over that for the next
Right.
15 million far more affordable. So you get the benefit of you collect a premium payment for years to yourself, invest that surplus premium, and it makes investment earnings at a far greater rate than what the commercial insurance markets can do because they're restricted by investing in equities by only 10%, whereas captives can invest up to 90% in equity markets. So it's just a better financial performing vehicle than a commercial carrier.
That makes sense. Well, the audience is probably wondering, is that the reason why all the costs are going up? Because everything's tied to insurance, and is that why we're seeing costs skyrocket because of the Strait of Hormuz, and that's affecting the globe in business
Yeah.
budgets?
So we're in what's called a hardening market in multiple different types of insurance. And
Okay.
that is when the markets are soft, and what that means is just not a lot of claims volatility. And
Hmm.
also we've seen, the commercial markets of equity investments have been performing incredibly well. But when events in the world are transpiring that are becoming risky, you get the soft market mentality. We'll just pay these claims because we're not going to litigate all this. And you get a lot of that kind of
Hmm.
insurance behavior when the claims are low and their investment earnings are high, they'll pay claims. And they create this behavior where when the market starts hardening and insurance costs are going up, it catches up to them. And they've been paying and developing this culture of paying claims that aren't really should have been litigated, but they just don't want to take on the expense and still have the risk. So they settle them. And so now what we're in a situation of multiple different markets like
Hmm.
cyber. Cyber has been in a hardening market for years. It's now softening a little bit, uh,
Hmm.
but still not. It's still in a hardening market phase. That means just it's harder to get coverages for cyber. They're limiting how much they'll cover. They're narrowing the scopes of coverage, and people think if they got cyber, then I'm protected whether if something happens to me, and that's just not true. They need to fully understand the exclusions that exist in those commercial policies. And for our captive clients, when we build our captive insurance companies, like I say, we don't focus on exclusions. We focus on coverages. So we want
Hmm.
broad interpretations of our policy, and we're the ones as captive owners, we're interpreting our own policies for the purposes of paying claims.
Here's a curveball kind of question.
I love those.
Now you kind of you've had your toes into the security consulting world, I'm sure, and I know the big business and risk assessments, threat assessments. My question is for the audience probably is wondering this too. Do you need to have a policy if you're going to go to a business entity's workplace to do a risk assessment, what is your recommendation on that since you're in that
Well,
role?
two things. Number one, the question I don't know, I don't think you're answering, but I'm going to answer it because I think it's important to your audience.
Absolutely. Sure.
And that is, I think it's important for a lot of a lot of the companies that are your clientele have captive insurance companies, and so it's important to realize they can write safety grants through the captive to the parent, and so that will
Wow.
pay for your services and your assessments because the
Whoa.
policies that they have in place are basically enterprise risk management related policies, and that's what
Absolutely.
you guys are doing is providing enterprise risk management related threat assessments and services. Whether
Hmm.
it's hardening of targets or whatever, those can be paid for. Services can be paid for as in a vendor relationship from the captive. So when you go to make a marketing call on somebody, it's a budget neutral request that you're making, and you can't do that unless they have a captive where it's truly budget
Uh,
neutral. And so for
okay.
you, you say this is not going to cost you, it's not going to show up on your bottom line. It's going to show up as an expense of your captive, which is exactly what it's supposed to be doing there. It's supposed to make the company safer. So first part is I would use
Hmm.
it as a marketing tool to talk about how budget neutral, them using their captive funds to pay for threat assessments and risk assessments and things of that nature. Secondly, yes, there is risk to security professionals who are going in and making recommendations and assessing because it's basically it could be professional liability, it could be
Hmm.
D&O, what's
Yeah.
called directors and officers related liability. If someone under your supervision makes a certain analysis of a threat and that threat was underestimated or overestimated perhaps, and there's risk and damage to the business that comes the client suffers based on recommendations that were made or omissions to act, then you would be insured for that, and you would be able to have control over the claim yourself and not dependent upon a commercial insurance company for that.
That is wild. I feel like I'm in a master's program for my MBA at Hanford University. Whoa. Thanks, Kyle. I feel like I'm a student in school today for an hour. Yeah, that was pretty powerful. Now, I know the big issue with providers like myself out there in the marketplace, the big conversation I've seen a lot lately in the last 6 months or so, everybody's premiums are going up. Everybody's
Yeah.
rates are going up from the small company, the boutique. Everybody's rates are being doubled, if not tripled, this last year. And people are like, how the heck do people survive being a small business? Do you know the reason behind the premiums hikes and all that? Is it because of
Well, I think
threats?
the overall operating expenses of the insurance companies have gone up because claims have more volatility. So, and they're costing them more money. So, if you look at the whole life cycle of a claim, it is
Hmm.
costing more money now than it ever has before. And also, I think we're in a situation where the actuarial tables don't really fully understand AI related risks yet. And so, a lot of
Mm.
them are they're overestimating AI risks to certain types of business. And it's the same thing with cyber. If you have really good cyber programs and enterprise risk management over your cyber operations. It's like physical security. If no one understands your risk better than you as a business owner, but you
Hmm.
also have to make sure that you're making the investments to keep up with that. And a lot of times what we see is people have not made these investments in cyber in their cyber operations. They've made the investments in cyber insurance, but because they haven't made the proper investments, by the time they get a claim, there's exclusions because they haven't updated all their software. They don't have all of these types of things in place. And so there's a lot of exclusions that exist in cyber claims. And so I think that we're in a tweener period of time with cyber, AI, property, weather related events, which are more demonstrable and clear to understand. But
Hmm.
and so a lot of these insurance companies they're using all of these modalities of different types of insurance lines of business to help offset the ones they're having the most highest claims in, which is property, cyber, and things of that
Hmm.
nature. And with property, we are able to help people even on property insurance. And we build in the tower and we do lots of different creative things to offset the problems that they're experiencing. But I'll give you a real world example. We have a client who has, you know, nine figures of real estate, commercial real
Wow.
estate, and and of course, they owe about 300 million on that $900 million portfolio, but the total insured value of from an insurance standpoint is
Hmm.
500 million. So they have a
Whoa.
gap of $400 million of from a bank standpoint, non-collateralized, loan or value
Hmm.
Their collateral is essentially non-insured. They got the 300 million loan. They've got only 500 million in protection. So there's another 400 million that's essentially uninsured. And so they're using captives to bridge that gap. And we do captives for banks that are bank sponsored captives where the bank will get on the risk with their loan customer and to solve the property increases so they're covered. And then so the bank is making money off their client's risk, which is a brand new revenue stream. The client is solving their insurance problem and their banking problem and making money off of their own risk. And the commercial carrier is sitting there like, hey, this is fine. Now you basically, I'm indifferent to this. And now their commercial
Hmm.
insurance spend is more affordable to them because they're taking the more volatile, lower dollar amounts in the first dollars of coverage. So that's just one example of being creative and with different types of things. And then when you do that with all these different lines of business that you have,
Sure.
key person. People think of key person insurance as a life insurance policy, and it is, but it can also, in a captive structure, can be key person within your company. Because when someone leaves, there's demonstrated costs that it takes to replace, train, equip that person, plus the lost revenue, and then efficiencies that are an economic loss associated with that person leaving. Now you can, when you have somebody leave, now you got to recruit somebody, you got to pay relocation expenses, all that. That's a risk that you can put into your captive and a key person policies, and we do that quite regularly for our clients. But
Now I
generally, to
see
answer your
why.
questions, insurance has gotten more expensive because claims have gotten more expensive, and and
Gotcha.
and so when you have, and that's hardening a lot of these markets. And
Mm.
I think there's also actuaries have not caught up with what the real true risks of AI are. We've seen this in the firearms industry for a long time. There's
Hmm.
a misperception of risk based on certain categories of business. And we've seen shifts in those to, historically
Hmm.
property was very stable. You'd have your big large loss every 5 to 10 years on a weather related event. But, other than that, but they were going to make plenty of money off of you in the interim. Well, now that we're having these large weather events that, are believed to be climate related, those aren't going away and they're getting the intensity and the scope of the damage of those are getting greater. So that's you're really not paying for claims that are happening now. You're paying for claims that are going to happen in 2, 3, 4, 5 years. The perception of claims happening with greater frequency and volatility down the line. And so that's captives are a way to kind of leverage the commercial markets and to lower your expense, or you can just
Hmm.
certain businesses can put all of their insured risk in their captive and be completely out of the commercial market.
So I think from what you just said, premiums will still keep on going and climbing with ongoing risk threats. We have crypto, we have AI now. And I sat next to a banker on a flight from, I was at OSAC last year, and I think he ran a private equity or something. We're sitting up there talking, and he said, "Yeah, the biggest risk right now is AI and crypto. Banks don't know how to forecast it, so that's the biggest risk we don't even want to touch. We don't understand it, but we're forced to, and that's going to create probably a domino effect in coverages for everybody, especially when it comes to insurance and exposure. I guess is my theory."
Yeah, and then the problem there is in the commercial market is doesn't understand it any better than anyone else, and so what winds up happening
Hmm.
is the commercial market, out of the fear and they want to make sure that they can control their
Yeah.
losses, and so they're excluding a lot
Hmm.
of things in large blanket exclusions, and so you think you have insurance. In fact, you don't. Here's an example of a way that people think they have insurance. You can get a business owner's policy that has that's a few $1,000s a year for a small business, and you think that you're covered under business interruption,
Hmm.
but you're not. Let's say the business interruption has to occur within your business. The toilet overflows over a weekend and floods your office. Okay, that's likely covered because it's an interruption of your
Hmm.
business coming from your business. But let's say building uphill from you, the business ruptures a line and it comes down and floods your building. That's third party business interruption. You're not covered. And so people
Gotcha.
see that all the time. I've been called by, people who was like, "Hey, I've made a claim on my insurance and they denied it, and I've got, $3 million worth of damage caused by someone else." It's like, well, that's, third party. They're not going to cover that. It's specifically excluded from your policy. So we get people all the time driven to captives because of the fact that they've had, a large loss that should have been an insured risk that was excluded by the commercial markets.
That is wild. Just being it, having the bandwidth and the genius to explain that. That's pretty impressive. Wow. Someone's got to know how to do it. That's why they hire
Yeah.
you to be their consultant. So you're,
Yeah, good.
go ahead.
I was just going to say that the thing that's so interesting to me about we're kind of we're guides, but and once it's like there's
Mm,
a Rubicon psychologically. Once you realize, and for our captive clients, we once they realize that the risk is in fact a commodity, they're going to make it whether they want to or not. So they
hmm
may as well just say, throw their hands up and say, okay, build me a captive insurance company, which is not incredibly expensive to do, and get it licensed in the state where I want it in and get it going. That's about a 4 month period of time on average. It can be done faster for, if it's not an overly complex matter, but the captive industry exists to do the things for a business and let it get all the benefits of having its own insurance company, but also have greater capacity, greater control and over the risk. And also when you own your own risk, literally, you your enterprise risk management improves significantly.
hmm
When everybody in your world of your ecosystem of businesses knows that, hey, this is Mark's money. This is not Allstate or Chubb or Liberty's,
hmm
or Lloyd's of London's money. This is Mark's money.
mm
There's an immediate, enterprise risk management benefit because people take ownership of that. And when with captives, we tell people, let us educate all the people in your business, your division leaders, your supervisors, and everybody in your business, because they're going to understand that how the captive can be leveraged within the company to provide benefit by safety grants and things of that nature, or buying material and equipment, software, that kind of thing. It can be used to improve their operational risk and safety measures. So that includes physical security, executive protection. There's a lot of these types of things that we've been doing for our customers their employees in their world sees that things are different. The company now actually takes a more of a meaningful ownership interest in the risk, not just farming it out and everybody's just waiting each year to find out how much your insurance has gone up. You can take control over that.
Now, my thought and question is this: can I start my own insurance company, basically, and just like you just explained, and just go down the file paperwork, but as a
And
company,
not,
is
I mean, well,
is it that
if you were a
easy?
lawyer, if you were a lawyer, a CPA, an actuary, and all those, you could. There wouldn't be anything preventing you from doing that.
Yeah.
But what we do is we build it, and so Helio Risk works in
Okay.
essentially three phases. The
Got it.
first, the first, before phase one is engagement letter. So pre-engagement letter, everything is for free. We're
Mm,
doing an evaluation of whether if they have a sufficient insurance spend to justify a captive, and if so, what type of captive? Because there's multiple different types of captives, and so but they need to have insurance spend sufficient to justify being in a captive program, and then we need to understand all their risks or their claims over the last 5 years, and then we look at their business and their taxes and their revenue sheets and their P&Ls and all that to determine what areas may be uninsured or underinsured that they currently have. And then we essentially meet with them again, and after having signed a mutual NDA and going through that, and we present them our findings of whether we think they're a captive candidate or not. And if they aren't, we don't want to take a red cent of theirs and then have them this be a bad experience for them, and have them where they're not gaining enough investment earnings to offset the cost of the captive program, which is really the gold standard. We want that to happen as fast as possible. So the investment earnings in most captives pay all the operating costs of the captive plus continue to generate profit. So for my captive that I own that's called Bold Lane Insurance, our investment earnings pay the overcome the cost of the captive itself, which
hmm
is captive management, audited financials, all that kind of stuff, regulatory expenses, and generates a profit sufficient that we have used it as essentially private equity fund. We've acquired, banks, we've acquired insurance companies, we've acquired competitors, and we've done things that have overall, increased the financial health and success of our parent businesses. So captives basically it is a insurance company that is built that can only insure the interests of the parent or subsidiaries. So
mm
you can't have a captive and then sell insurance to third parties unless you do that through what's called a fronting carrier, which is a licensed commercial insurance carrier that will let you basically rent their paper. So you're
Mm.
writing, I'm writing company C. Uh, my captive company A is writing company C insurance, commercial insurance, but it's on the paper of insurance company B.
Whoa.
And so that's a way that allows large companies to essentially act as a commercial insurance carrier when they're not licensed as a commercial insurance carrier. And then the fronting carrier, which is the licensed commercial carrier, it will decide to take none of the risk or some of the risk, as well as the seeding fee in order to the fronting fee, which is usually anywhere from 3 to 6 to 7% of the premium payment will be the fronting fee.
Wow. That's a whole different world. That's why you do
It
what you
is.
do.
Yeah, and there's insurance carriers, commercial insurance carriers who they only sell, they only do excess, they only do reinsurance, and there are captive
Mm.
reinsurance companies who participate with other captives in
Hmm.
their reinsurance limits.
Whoa. That is crazy. I yeah, I mean, it's so vital. You have to have that, especially if you're in California, litigation state.
Yep.
Now, here's the question: is California the worst litigation state in the U.S.
It
domestically?
depends. It depends on the category. If you
Okay.
look at auto claims, you can look at New York and New Jersey. If you're
Mm.
looking at healthcare, medical malpractice related, injury cases, it's New Mexico, Florida, South Texas. Used to be bad till they had constitutional tort reform, which improved somewhat. And
Mm.
uh, and and those there's Chicago is the third ring of hell on medical malpractice cases. Philadelphia, we do a
Wow.
lot of healthcare management of captives and risk retention groups there, and they pay a lot of money to plaintiff lawyers.